Hello everybody, Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is Friday, November the 8th. Yes, I've not done a video for a while, to be quite upfront. I've just been feeling a little bit uninspired lately with the housing market. Seems to be the same old stuff over and over again, and there hasn't been that much material news as far as I'm concerned. We typically go through waves where we hear a lot of information, and it's getting a bit boring. I mean, it seems like this housing bubble is never ending, and the Fed and everybody else that's out there is trying to prop the market up as best as they can to keep it going and going and going at the current pace. Who knows what's going to happen? I got some ideas. Let's talk about it right now. Now, today is going to be a longer video. I'm giving you fair warning. I've got a lot to go through here. So please have this as your warning. It's going to be a long one, all right? So first comment I have is that every time I step into my vehicle and I drive around town, whether I'm looking at properties, doing personal errands, picking up my daughter from school, or whatever the heck is going on, I seem to be hearing a lot of iBuyer ads on the radio. And I've noticed this more and more. In our area, we have a number of iBuyers right now. I'm hearing a lot of open door, I guess you could say, ads, and I hear something new from a company called Rex Homes. I think it's REX, Rex Homes. I don't know as of yet. Haven't looked them up, but I'm hearing those two quite often. Typically in the same drive, a few times, every driving session I'm doing, and different times of the day. So we can certainly see the iBuyers are starting to proliferate the market right now and are trying to get market hold wherever they show up. So they've got financial backing, they can spend money on stuff like this. But just as an FYI, noticing a lot more of that before than I really ever have. All right, talk about Mr. Robert Shiller. So we all know who Mr. Shiller is. He's a Nobel Prize winning economist from Yale University. He is responsible for and co-creator of the Case-Shiller U.S. Home Price Index. So he's often looked to as commentary and advice and guidance on the markets with respect to stocks, bonds, housing, etc. So he has a book out now, and it's called the oh Lord, what's it called here? It's Narrative Economics. So his sort of new platform is we're all about stories now. It's not just numbers, it's about what's going on, and there's a picture to be painted and a story to be told with respect to the economy and how we play into it. So of course, his comments, so he's been interviewed quite a bit now as he's going across doing his book tour. Basically, he's saying that Shiller sees bubbles in the stock market. He expects lackluster future U.S. stock returns. What else is he talking about here? The bond market boom is unstable. And regarding housing, his comments are, so Shiller on housing, it's just like 2005 again. Shiller says, it's like a tongue twister. Shiller says the housing market is in a bubble phase, not unlike 2005. That was the point in the housing bubble was inflated, but yet to go parabolic. It's like 2005 again, he said. San Francisco and LA are already slowing down. That's a bad indicator, he said, as those markets have been going up for years. Real estate stocks are on fire too. He noticed that there's one, for example, the real estate selector stock is up nearly 29% this year, blowing away the S&P's 500's 20% gain, and it's second only to the tech stock as the top performer sector of the year. Yet, given the housing bubble isn't as excited as it was in the early 2000s, he's been reluctant to call it publicly a bubble until now. And he thinks enough people remember the 2000s housing bubble so they recall that home prices really do fall, but we're not as exuberant now as we were back then. So again, this is interesting. Once again, Robert Shiller, as far as I'm concerned, doesn't really come out and say much. He talks a little bit in riddles or circles here. The point, though, is that it's not unlike 2005. Now, previous interviews that he's given, he has mentioned that the signs were there with respect to the housing bubble in 2005, but we just weren't looking for it, or I guess you could say receiving and interpreting those signs that the industry and the marketplace was telling us. So we're kind of like 2005, which is really about 2 years at that point in time ahead of the housing bubble, which really you could say, we peaked in 2006 and the crash happened in 2007. So we're kind of right there right now. We've seen decelerating appreciation. We've seen some markets drop in value. We see less inventory out there, and we do see, but again, we see little ebbs and flows with respect to property prices, which is kind of annoying for most people. Now, one of the points I want to make right now is 2006 was the housing bubble, the previous housing bubble. So we had a growth phase, we had a bubble, we had kind of a crash and a bust crash correction, and we are as far as people and economists, analysts, everybody out there, pretty much on record that a housing bubble, the first one was in 2006. So we've identified that, we've acknowledged that, we call it that. As a matter of fact, it was part of the whole GFC, which is the global financial crisis. So I want to point that out. So where we are today with respect to the last case Shiller, I guess you could say, information, is we are 14.9% above the 2006 peak as a national composite across the board. Granted, some markets may have recovered and gone above where they were last housing market. Some markets aren't quite there yet, and some markets really never saw a true housing bubble. So this is the first time around for them. But from my perspective, we are, and not just my perspective, from what I'm saying here is that according to Case Shiller, the information on the national level, we're 14.9% greater than we were back in 2006. So as far as I'm concerned, I'm going to call it a bubble. Listen, I'm like everybody else out there. I listen to the videos, I look at the news, I see what else is being talked about out there. We are in a bubble, so there's no denying that we're in a bubble. The issue is going to be where the bubble goes and where it ends up. That's, I think, the difference compared to 2004 through 2008, 9, 10, etc. But again, and you probably can't see this, but if this was 2006, then this is 2019. We are greater than 2006. And for those of you who don't like my graphics or my graph quality, we'll say, this is a printout from Case Shiller's website. So, I just highlighted the dark line here. The peak of 2006, where we are now, we're almost 15% greater than where we were. So please keep that in mind. Again, where it goes is the issue. So, we are in a bubble. You can't deny that we're not in a bubble. It's how the bubble is going to play out and where home prices are going to end up. That's the question. That's the issue that we're all dealing with here. All right. Now, and what I'm going to do is I typically set my news discussions up, through, I guess, in a theme based, where I'm kind of pointing or painting a picture and I'm kind of getting to a point. And as an FYI, just because I respond to and I read the comments and everything, I don't make this stuff up. This is actually in the news. You can go look at it online till your hearts are content. So I'm not saying nothing that isn't already published in the news wires, the housing forums, etc. Now, more Americans say now is a bad time to buy a home. So according to, this was on CNBC, but this just came out because I believe it was Fannie Mae has a home price or home purchase sentiment index, and they publish the results every month. Well, 21% of Americans say now is a good time to buy a home, a drop from 28% in September. According to a monthly sentiment survey by Fannie Mae, there was also a decline in the share of people who think now is a good time to sell a home, from 44% to 41%. The problem is price. Affordability has weakened considerably since the surge in summer buying. So less and less people think now is a good time to buy a home. This is not me. This is what Fannie Mae is saying. Now, consumer home purchase sentiment remains robust. This is the spin on things. So that's the facts, which I just said here. It's dropping. The sentiment is dropping. But how the spin is, according to Fannie Mae, is consumer home purchase sentiment remains robust. And for a second, even though with the HPSI still near its survey high, despite dipping for a second consecutive month, said the chief economist for Fannie Mae. The good time to buy component has declined notably despite lower mortgage rates, which again, lower mortgage rates, not giving us what we want out of the housing market, due in part to the persistent challenge and of a lack of affordable housing supply. In turn, the net share of consumers expecting home prices to increase over the next 12 months has fallen to its lowest reading in 7 years. So even everyday people expect the fact that we're going to see less and less increases. We all know personally, it just can't keep going up. It's going to have to give at some point in time. However, still, low mortgage rates and a strong labor market are supporting the index's overall strength, which is consistent with our expectation for a modest expansion in home purchase activity in the fourth quarter. So, Fannie Mae sees things are still going to expand. We're going to have more sales, more activity. How they can come to that conclusion based on the fact that the numbers are saying there's less of us think it's a good time to buy a home, less of us think it's a good time to sell a home, which means you're going to see less activity in the marketplace. So again, it's all about how you spin things. U.S. home prices accelerate as housing supply tightens. The average American home listing price reaches $312,000 in October. So in October, the average American home listing price climbed 4.3% over year, reaching a high of $312,000, according to Realtor.com's trend report. And essentially, the company indicates this growth is partially attributed to a decline in housing inventory, which resulted in the heightened competition during the month. Now, again, this is not sales. This is the listing price. So I can list my house for whatever I feel like I want to do and price it, effectively or ineffectively. So this number is not a sales number. It's not indicative of sales and what's gone on and what's truly happening in the marketplace. It's a listing price average, which again, I have sellers who call me and say, well, I'd like to increase I'd like to offer my home at this price. I may say, well, that's a little bit high, but they still want to do it. So, you can inflate your listing price as much as you want. Where it sells is going to be more realistic with what the market will bear. So again, another kind of spin, I guess you could say, article out here. It's not sales price. It's not even, so it's not even a pending sale. It's not even a sold. This is a listing, and listing prices have increased slightly. So please keep that in mind. St. Louis Fed report. We'll talk a bit about mortgages here. So there was a report that the Federal Reserve Bank of St. Louis put out about down payment assistance not linked to increased default risk. Policymakers should take care not to close off opportunities. So, as time goes on and as things become more expensive, mortgage companies and lenders are looking for ways to attract more buyers and get them into housing. So how do we do that? We lower rates, and we also lower guidelines and standards and things like that. So of course, down payment is a big barrier to entry for a lot of people to purchase a house. So clearly, FHA, Fannie and Freddie, they are offering 3% down mortgages, but there's also a lot of other down payment assistance programs. So if you don't have a down payment, even 3%, there's groups that can get you in that home for virtually nothing because you're working through down payment assistance programs. And I guess what they're talking about here is that that's a good thing, and the people who are using down payment assistance typically are people that need it and conversely appreciate the home ownership process and owning a home and are going to be good homeowners. That's what they're kind of saying here. I guess you could say down payment is one of the biggest barriers to home ownership after years of home prices increasing at a faster pace than wages. So that's what's most striking about the return to high leverage home lending is the proliferation of more than 2,500 privately sponsored and government-funded down payment assistance programs across the countries, which have the collective effect of reducing the first-time home buyers' contributions from as little as 3% to something substantially less. Well, if FHA is looking for 3%, and this is going to reduce it to substantially less, that's 2 or 1%, which to me means less skin in the game. So that's kind of my point here, is that we will always, when the market's at its peak and lenders are looking to lend and governments are looking to underwrite mortgages and things like that, we broaden the horizon of what's available to anyone, especially first-time home buyers or more economically challenged buyers, to get them into properties. So whether it's a good or bad thing is irrelevant. The whole point is that, and my point is, the more we make this available, the less risk for the homeowner, the more risk on everybody else. And I always go back, you jump in, you take a 3% FHA loan, you are immediately underwater when you close the home. Because if you were to sell the home, for the same price you bought it, you're going to have closing costs and commissions. You're going to be underwater. It's 5 or 6% standard commission if you use real estate agents. Closing costs are usually a couple points. You're already negative equity in your house, so you're stuck. So the less we provide as down payment, the more we subsidize. To me, there's not the attachment there for home ownership. Now, again, I'm not speaking for everybody. I guess my opinion going that those people could walk away from their mortgages a lot easier, or they're more at risk to be underwater with subtle shifts in the marketplace, which could trap them in their home. So just keep that in mind. As we talk about mortgages. Believe it or not, that the $11 trillion U.S. mortgage market has a shadowy new player. So basically, we've got the Federal Reserve and the Treasury Department have been put on notice about the risk of an economically damaging cash crunch in the $11 trillion home mortgage market. So behind the concern, there was a Financial Stability Oversight Council, and it's the rapid growth of the so-called shadow banks or non-banks servicing home loans and originating loans, especially riskier loans. And I guess there is a professor named Nancy Wallace from University of California at Berkeley says there's a real weakness here. I guess many of these firms are financially fragile, and she, I guess, did a 2018 paper titled Liquidity Crisis in the Mortgage Market, which I do believe I have seen that. And the reason why they're financially fragile, because they're dependent on short-term bank credit lines that could be pulled at times of financial stress. The worry is that could end up hurting the housing market and the economy as the financiers are forced to cut back or curtail their mortgage business. There you go. And as conventional banks pulled back from the mortgage market due to limited profitability opportunities and increased regulation after the financial crisis, these other mortgage companies, these non-banks, the shadow banking industry people flooded into the marketplace. So they currently originate 70% of the agency-supported residential home mortgages and about 90% of the riskier loans backed by Government National Mortgage Association, or otherwise known as Ginnie Mae. And 6 of the top 10 originators of home mortgages in 2018 were independent mortgage lenders, these non-banks, with Quicken Home Loans being the number 1. So they're not regulated by the Federal Deposit Insurance Corp. They lack the deposit base and access to emergency Fed financing that commercials bank enjoy. So that's kind of the situation. So as we've mentioned in previous videos, that this group is taking over originating the majority of loans. So if we're moving people into lower down payment loans, the non-bank shadow banks are the ones that are going to be originating these loans. That's where they are today. We know that the big banks have asked to be on level playing field, and they want to do more of this. They want to be involved and have the qualified mortgage patch removed or back in play for them, as opposed to just the government entities, the GSEs. So we'll see what happens. Of course, the pushback is that Quicken Loans guy says the focus should be on capital and the ability to withstand fluctuations, not whether the bank's a non-bank or not, and they say they're better capitalized than 93 to 94% of the FDIC insured corporations. So this will play out over time here, just something to think about. And again, when we look at down payment assistance, more and more shadow non-banks originating loans that are sponsored by the government, to me that's more risk, and that's what we're doing at the height of the market, not at the start of the market, like the last housing crisis. We started it there. Now we're ending up with it at the height of the marketplace. In other news, Apple, Facebook, Google, and Amazon are now putting or pledging billions of dollars towards affordable housing, but people say that may be a little too little and too late. So major tech companies have pledged billions of dollars in recent months towards affordable housing initiatives in a bid to alleviate the housing crunch in places like San Francisco, Seattle, Silicon Valley, etc. But some experts say it's too little too late. So just so you know, when you take a look at this, is that how much have tech firms pledged in 2019? Amazon, 113 million, Apple, 2.5 billion, Facebook, 1 billion, Google, 1 billion, Microsoft, 1 billion. So the whole idea is that they're pledging to either use their land that they already own, or their cash, to start to build and develop affordable housing so they can essentially house their employees. And the kind of irony here is that the problems in the Bay Area and Silicon Valley and what these large groups are experiencing are largely a byproduct of their own success. So all the .coms and the IPOs and all the tech growth in the San Francisco, Silicon Valley area has spawned a lot of wealth, which has pushed prices a lot higher. So of course, people that were involved maybe early on, or the executives are making really good money, can afford these homes. But your typical employee that works at any of these tech companies are having a hard time actually making ends meet and working and living in reasonable proximity to where they work. So we've heard the stories of cohabitation, people, roommates, people living in their cars, living in RVs and Walmart parking lots. We hear all of those things. So I don't feel sorry for these guys. I think it's good that they're bringing it back, and they should bring it back. But I also look at it as a controlled environment. The fact is, okay, you're going to work with us, and I know darn well in the future that these groups are going to partner with probably mortgage companies and things like that. So if they're going to put the money out to house their people, etc., they're probably going to have controlled programs where, okay, if you're going to buy or live in one of our, affordable housing units that we've developed and put up, you're going to use our title company, our mortgage relationships, whatever. So there's going to be give and take here, but no one's doing anything for free these days. It's got to be some end money coming in for them to do this as well too. So there you go. Now, which brings us to interesting thing that I found out: are homes under $250,000 nearing extinction? What this could mean for home buyers under the age of 35. So a recent report by the economic research consultancy Capital Economics shared a stunning statistic. The number of vacant single-family homes for sale priced under $250,000, or $250,000, has been cut in half since 2012. So according to the report, at the start of the third quarter of this year, there were only 550,000 vacant homes in the market priced under $250,000. That's half as many as there were 7 years ago. So basically it boils down to, that's affordable housing. That's how we all define affordable housing. That's $250,000 segment and below. But we know that has the least amount of homes, which means there'll be more competition, which means that those that $250,000 benchmark, more homes will be priced above that, so that you could, but because you can, you're going to move it above that price point. Simple as that. So that's where the lower housing inventory hurts us, or hurts affordable housing, and that's the whole point of this, is that we just see less and less of that going on, which certainly is a concern, because let's face it, most people, this is what they can afford, and that's fine and dandy, but there's less and less of this out there, which is forcing them into the rental markets. And do I have something about that here? Yeah, which is, again, no vacancy. Apartment rentals nearly hit all-time high this year. According to a group called RealPage reports, when is the prime leasing season for most renters, especially those in the warmer climates? They tend to prefer to move in when it's warmer during the second quarter and third quarter of the year. In areas where it's colder, it's typically between April and September, which is about the same time frame. And essentially, analysis from them this year, so 2019 was the second highest apartment leasing season, with 281,800 units absorbed or rented. That's a lot of rentals going on. The highest leasing season was in 1997 during the tech boom, so we're seeing the second highest right now. Although high rental rates were seen across the nation, it was the southern markets that saw the record-setting seasons. There you go. So of course it talks about who has more demand. Dallas has a lot of demand, other places in the south, but across the nation, multifamily occupancy rates continue to climb as younger generations are opting to rent instead of owning. And in fact, multifamily vacancies haven't been as low as they are now since the year 2000. So we also know that there's a lot of multifamily growth that's gone on. There's a lot of multifamily, people looking to buy multifamily existing properties. We know there's been a lot of multifamily housing starts that have gone on the past couple of years. That's propped up the housing start numbers and permits. Again, this is just a factor. So less affordable housing is forcing people into apartment complexes, the multifamily, and we hear every so often of having apartment rents peaking in a lot of cities and hitting all-time highs as well too. So you're kind of getting hurt. You can't go find a place because you can't find one that's affordable to you, and you don't want to pay higher prices to go for the next pricing point, so you need to rent. And now we know that there's a lot of we're having a hard time getting rental accommodation that's cheaper, and because there's no vacancy, because stuff gets rented pretty quick. So there you go. Now, I've talked about this before. I talked about non-performing loans or non-performing assets. So every so often, the government, the GSEs, government-sponsored entities like, Fannie Mae or Freddie Mac, will sell off their interest in these type of loans. So Freddie Mac just finalized a $369 million NPL, non-performing loan sale last month, which should probably close by the new year. So Freddie Mac announced it sold via an auction 2,243 non-performing residential first lien loans from its mortgage-related investment portfolio. So the closing, the transaction is going to happen in January 2020. All right. So there were a number of people that bid on it, and they get their hands on those loans. So essentially, what it boils down to is, according to the FHFA, the purpose of sale of non-performing loans by the GSE is to reduce the number of delinquent loans held in their inventories and transfer credit risk to the private sector. So they're actually transferring the risk off to other groups that are going to pay them a certain number of pennies on the dollar, whatever that number is. So we don't know what this boiled down to, how much the face values are of these. But again, they're transferring that risk off into the private sector. So really, the sale helps achieve more favorable outcomes for borrowers and local communities than the outcomes that would be achieved if the enterprises held the non-performing loans in their portfolio. The sale also helps reduce losses to the taxpayers. Now, get this though, the NPL sold by Fannie and Freddie as of December 31st had an average delinquency. So again, non-performing loans are delinquent, so people aren't paying on them, so there's no income coming in. All right, they're in the non-payment or pre-foreclosure process here. They had an average delinquency of 1.4 years to 6.2 years, and an average loan-to-value ratio of 92%. So if your average loan-to-value ratio is 92%, that's only 8% equity on average that the homeowners have or had in the loans when they got them. All right, so these aren't great equity loans. These are you're basically high LTV loans. Nearly half of the loans sold, 45%, are from New Jersey, New York, and Florida, which we know are high foreclosure filing states. We know that. And FHA states that prior to start their non-performing loan program in 2015, these three states accounted for 47% of the loans that were 1 year or more delinquent. So New Jersey, New York, and Florida are the bad states as far as having delinquent loans that are held by the government. So given the delinquency status of the loans, the borrowers have likely been evaluated previously or are already in various stages of loss mitigation, including modification or other alternatives to foreclosure, or are in foreclosure. So basically, these are all people that are facing a foreclosure situation. This is interesting, though, and you have to understand this. Mortgages that were previously modified and subsequently became delinquent comprised 63% of the aggregate pool balance. So what that basically means, so out of that pool that's non-performing, 63% were previously non-performing, and they became loan modification loans. They actually, we'll call it reperformed, but now 63% of those loans are now back to non-performing. So in other words, they became delinquent again. So this is kind of the situation that we don't really talk about. More and more information is coming out about this in the housing industry and why we still have problems. So a lot of loans from the last housing crisis, whether it's 2007, 8, 9, 10, 11, 12, when we peaked and we crashed in the trough, a lot of loans went through a loan modification crisis. Granted, we had about 10 million foreclosures, but a lot of people did short sales. A lot of people who didn't do short sales or got foreclosed on were did modifications. So just this little group, out of this 2,000 and change, I guess you could say, NPL group that was sold off, 63% were re-default. So they had I guess you could say, solved their problem at one point, but they have re-defaulted now, which is kind of consistent. So as time goes on, we will see a lot more of loans that are modified fall back into re-default. It's a higher percentage of people who are modified get to the re-default situation. So please be aware of that. And again, additionally, the purchasers are required to solicit distressed borrowers for additional assistance except in limited cases and ensure all pending loss mitigation actions are completed. So what that basically means is if you're currently working with your lender on a loan modification or a short sale or something to that effect, and Fannie and Freddie sells these off to somebody else, these new purchasers need to honor that as well too. They just can't foreclose on you right away. But I know personally that when these new people come in and when they buy the non-performing loans, yeah, they may still deal with you, but sometimes their terms and conditions change. And we've had many experiences when we're dealing with an entity and we think we've got a deal or we've got a success story happening here, and then it gets transferred to somebody else via a non-performing loan sale, and guess what? They change the terms and conditions, which aren't as favorable anymore. So as much as this is what they should be doing, I know that they don't always do this, or they change the terms and make it more difficult for the homeowner, and quite frankly, they want the property back. They didn't buy this home or these non-performing loans to basically become lenders. They bought these to essentially work with the homeowners to get them out of the homes, and now to have the asset and utilize the asset in the future. To me, that's exactly what goes on here. So this is not a feel-good story whatsoever. This is more of a timing story. There will be changes as time goes on to these people, and most of them will suffer. All right, which brings us to another thing that I found, which is interesting. So I guess there's a real estate giant called Pretium, Pretium, Pretium. They bought Selene Finance. Selene Finance is essentially a servicing company. They service loans. And why this is important, which goes along with what I've just told you. So basically, Pretium is an investment management firm that owns one of the nation's largest single-family rental operators and buys loads of non-performing loans from Fannie Mae and Freddie Mac, what we just talked about. Interesting. All right. So they announced this week that it acquired Selene Holdings, and Selene Holdings is the parent company for Selene Finance, a mortgage servicer that focuses on non-performing, reperforming, REO and performing mortgages. So a lot of times when I'm dealing with a short sale homeowner in a short sale, the lender has transferred the servicing rights to someone like Selene Finance. So that's who I'm dealing with during the short sale process and negotiations. So this is where we have what I think I have an issue with that, and we all should as well too, because you have essentially a fund an investor who buys loads of non-performing loans, is one of the nation's largest single-family rental operators, who are now buying a servicing company who now is servicing loans for we'll say other lenders when their clients are defaulted, not paying their loans in pre-foreclosure status, whatever. So do you not think that's a conflict there? Because Pretium, whatever it's called, bills itself as the largest private single-family rental owner and operator in the U.S., has more than 32,000 single-family rental homes in its portfolio. So that's really cool. So once again, their position to be a holding company they own is a direct to client, direct to homeowner, to basically give them solutions that hey, we'll help you out with your loan modification, short sale, foreclosure, whatever, knowing full well that the end game in this is for these guys to eventually acquire the home somehow, some way. So I look at it going, it's one more example. The big are getting bigger. There's like a cartel going on here in housing. How is this not a conflict of interest that the owner of a servicing company designed to work with homeowners ultimately, it owns one of the largest rental portfolios in the U.S. We know they want the home. They've now bought the connection to the end user. Look at that. I think it's a huge conflict. And, again, why don't you just loss mitigate your home into our rental portfolio? That's how I look at this. So we're going to see more of this going on. We're going to see more consolidation happening in the industry. So that to me is disturbing, and that's why homeowners need to seek out solutions, short sales, loan mods, whatever, and really push the envelope and not just give up and let these guys take your home, because that's what they want ultimately in the end. All right, last bit of the news here. We've got some information that came out from Atom Data Solutions, Atom Data, and they released their third quarter 2019 U.S. home equity underwater report. So this is third quarter. I don't recall seeing second quarter information here, which I do find a bit suspect, because maybe second quarter wasn't good, and the reason why they're releasing the third quarter, because it's better as far as they're concerned. All right, and I guess it is overall. So ultimately, out of the entire amount of homes in the U.S., 14.4 million residential properties in the United States were considered equity rich. Okay, which is great, and that means the loans secured on those properties are less than 50% of the home value. So if you have for example, if your home's worth $200 and your remaining loan balance is $85,000, guess what? You're equity rich, because your equity is greater than 50% of what's out of the loan value. So that's kind of cool. So on the flip side of this, the underwater number has changed. So the past number of quarters, and again, I don't know what the second quarter was because I didn't catch this. I always look for this report, and I found it very concerning that they didn't release the second quarter. They've skipped it now. They've talked about the third quarter. So just 3.5 million homes are now technically or are severely underwater. That's a drop from about 5 million homes from quarter one. So of course they're going to go, this is great. Look, we've now gone from 5 million severely underwater homes to only 3.5 million. That's a $1.5 million swing the other way. Okay, good. We now know that Shiller is almost 15% greater than it was back in the last housing crisis. So yeah, this is something that I would expect. I didn't expect to see that big a swing though. So I think that's a little bit interesting. I don't know how to look at this as of yet. Realize the term seriously underwater means that your mortgage balance is 25% or greater than the value of your home. All right. So your home is worth 100. Your mortgage balance is at least 125,000 or greater. So you're technically underwater. You can't sell your home unless you bring money to the table to pay off the loan balance at closing, or you do a short sale and you're forgiven for the debt. So that's the thing. So what they're touting is that the latest numbers reveal another profound impact on the extended housing boom as far more homeowners find themselves on the right side of the balance sheet to the wrong side. Well, that's great. So there you go. So I'm not going to get into too much more about this, but I just found it interesting that we didn't hear about it last quarter. We're hearing, like the second quarter. We hear about third quarter. Why? Because it's a positive number. All right. That's my sort of take on that. Based on, if we are still appreciating, that should take place. Appreciation is slowing down, that we know, and we'll see in the future if this number does change. Because how I look at this is that a lot of the loans now that are being taken out, again, if we're talking very small down payment and very low down payment or small down or almost non-equity type loans that people are taking out, okay, you're going to be even. Your home's worth this, your mortgage is about even with you. Once we start to see a shift, again, the underwater homes can come up in value, or the rate or the number of underwater homes can come up again. So just keep that in mind. This is kind of my litmus test for what's going in the marketplace. But hey, we still know that foreclosure filings are increasing. We still know that more and more people are having harder times in the economy, and things are changing. Everywhere I look, we hear recession talk. We hear, people, jobs. Sure, maybe the job wage, jobs are going okay. It ebbs and flows, but wages are not keeping up. More and more people talk about wages not keeping up with housing values, and that's going to come and get us at some point in the future. So where is it going? What does this all mean? It means that we still see higher prices, and we don't see the drop that we'd like. We hope to see something in the new year, something material. I do believe that all the sentiment and things that we hear, that people are just tapped out from a lot of different ways. And time will tell how this plays out. So we have a bubble. There's no denying we have a bubble. The issue is how it's going to play out, and that's what I'm grappling with. I have my ideas. I want to see some more indications before I share them. But in the end, I still strongly believe that where this is headed, when you take a look at the situation, how we're being groomed to buy more expensive homes, how these other groups like these hedge funds that are buying mortgage companies and stepping in to really get the inventory before it comes to the general public. So I think that's a concern we all should be aware of, and we should actually prepare ourselves to combat that as time goes on. So that's it for today, guys. A lot of talking because I haven't spoken for a week and a bit, and there's a lot going on. So again, you've seen this screen flash up here, what's going on. If you want to communicate with me, Randy at Luxury Short Sales, I really do believe that now is the time to involve yourself in looking at the distressed market, particularly the short sale market, because that's a market that's not being looked at. Again, these larger companies don't play, as much as they're going to acquire, the servicing companies, they don't actually knock on the door or market to the homeowners that are facing the foreclosure situation, which is what groups like I do. And that's the way you can get yourself on better priced homes and not pay premium for stuff that's out there in the marketplace. So having said that, if you're not a subscriber, please help my page grow and subscribe. Thank you for the likes, the comments, and the shares. If you want to get in touch with me about what we can do together, just drop me an email and we'll go from there. Thanks very much. We'll look forward to speaking with you next week.